Just want to welcome everybody, and Dante is going to be joining us right now.
Hello, how's everyone doing? All right, so if you are in the chat, we do encourage you to put your camera on because we want to treat it more like an actual meetup because we can't actually go into a meetup now. If that's something you don't want to do, totally understand. Hope everyone's doing well. Thank you to everyone that is joining in with us. We do have a little change of schedule, and DJ will get into that in a moment. What we're going to do is we're going to go around the room real quick, take 10 seconds each, give us your name, what you're doing real estate related. DJ, do you want to take it from there as far as guest goes?
Yeah, absolutely. Do you want me to start with introductions, Dante?
Yeah, we can do that if that works best for you.
Okay. Do you want to give people a few minutes to join?
Yeah. We'll give them about 2 more minutes to join, and then we'll take off.
And we'll start the introductions. Yeah, so we just, with not meeting in person and this event being there for networking, we just really want to encourage everybody to, because we're doing a little bit of a pivot, which we'll explain tonight, just really want to encourage everybody, your networking, your building of your teams. Nobody does this business alone. So what we'd like to do is tell us where you're from, company name, and what are you looking forward to? What are you doing? We do need to keep it brief because we got a lot of people jumping on, but give us a need. If you're looking for something, if you have something to sell, don't be shy. Please speak up. If you're, I know we have some passive investors on. So if you're looking at deals, if you're looking to learn, the thing I want to be really clear about is, you, at least as far as Dante and I are concerned, you're in a no judgment zone. We're all at different stages of our journey, and we're here to help each other out. I didn't come out of the real estate world, but one of the things I really appreciate now that I'm in with both feet, both arms, and the rest of me is the fact that a lot of people want to pour into you and that relationship building. So it's a little bit harder to do when we can't be face to face, but just trying to make the best of it. So with that, Dante, do you want to get started with introductions? You want to give another minute?
Yeah, let's do that. So I'll introduce myself for some people that don't know me already. A majority of you do. My name's Dante Belmonte. I'm over in Syracuse, New York. I'm a real estate agent. I am a local investor. I work with a lot of real estate investing clients. I've got a few on the call here. Shout out to you guys that are on. I'm a syndicator, podcast host. So I wear a lot of hats when it comes to real estate, but everything I do is real estate centered. Thank you guys for attending the meetup tonight. We really appreciate it. We're going to go over some changes that we have in the lineup here. But what we'll do is I'm going to go down the list here. I'll call out your name. And if you could just go ahead again, tell us your name, what you're doing real estate related, a company if you have one, and what you're looking for. Because with these networking events, it gives you an opportunity to meet someone that might be able to fill a gap for you that you're looking to do. So I'm going to start right from the top. It looks like it's in just about alphabetical order. We have Anita, if you want to go ahead and introduce yourself.
Yeah, I'm Robert. This is Anita. We're also in Syracuse. I'm a small business owner, and I have some rental property. She's looking to get into rental properties and possible flips and things like that. We know very little to nothing. And we're just here to gain information, contacts, and hopefully form a successful strategy.
Awesome. Well, thank you for joining us tonight. Next up, we have Brian. If you want to go ahead and introduce yourself.
Hey, Dante. My name is Brian Carr. I am the owner of a communications services company, voice and data and security services, things like that. I've been a passive real estate investor for the last 10 years, and I am looking to get into active real estate purchases and management and that sort of thing.
Awesome.
So I do not have any properties as of yet, but looking to get into it.
Awesome. Thank you for joining. Aaron, if you can go ahead, if you can hear us.
Hey, Dante, how's it going?
How are you doing?
Good. I'm Aaron Gillette. I own Gillette Property Solutions. I'm also local to the Syracuse-ish area. I've got 2 single families, 1 mixed use that's got a small storefront. And I'm really just looking to make contacts, expand my portfolio, And for everyone that doesn't want single families, please reach out because I will take them. Thank you.
Awesome. Welcome back, Aaron. We've got Zay Williams. Do you want to go ahead, Zay, if you can hear us? If not, we'll circle back to you. Okay. Alec.
Hey guys, good evening. How you doing? So I'm a residential and a commercial real estate agent in the area. I'm also an investor. I have single families and multifamily properties.
Awesome.
I'm in this group, and this is the first time on the webinar to meet others, draw parallels, make connections, and kind of just talk about what we all love.
Awesome. Thanks for joining. Brian, how are you doing?
Hey guys, I'm Brian, 24, in the Syracuse area, work at a marketing agency full-time, own one primary that I live in, and then one duplex.
Very cool. Like it. Welcome back. Connor.
Hey guys, I'm Connor Schwartz. I currently work at TG6 Management part-time in East Syracuse. We have 75 plus investment properties in the Syracuse area, and we're always looking to grow our investor pool, make new connections, and get more clients.
Awesome. Thank you for joining. We've got Dan and Chad.
Good evening, it's Chad. I'm in the Syracuse area as well. Full-time teacher, part-time real estate investor. Right now, just one door, but looking to grow that in the next year or so.
Awesome. Thank you for joining. Drew.
Hey, I'm Drew Dunlap. I'm from Southern Vermont, but I'm living in Utica right now, going to college at Utica College. I'm also working part-time at TG6 Management with Connor right now.
Awesome. Thanks for joining. Gavin. If not, Gavin, can you hear us? If not, we'll skip over you. No worries. All right. I've got two iPhones, two people labeled as iPhones. So if one of you guys want to go ahead, go right ahead.
Hey, everybody. My name is Tim Mullins. I'm probably one of the iPhones. I'm located in Orange County, New York. I'm actually closing in on my house tomorrow, so I'm looking to invest some of that money and learn.
Awesome. Thanks for joining. Jose.
My name is Jose Soto. I'm an investor outside, I live in Philly, and I invest outside of Philly. So single-family homes for the most part, and I'm looking to learn more about syndication and how that process works.
Awesome. Came to the right place. Lolita.
Hi, everyone. My name is Lolita. I'm an agent in Queens, New York, and this is my first time on the webinar. And I'm actually looking to have my first investment property by June. That's what my goal is. And I'm here to learn from everyone. And hopefully by June, like I said, I have my first or second investment property.
Awesome. Thanks for joining. Mark. Mark, can you hear us? All right, we'll go to Marianne.
Hi, everybody. I'm Marianne Cameron. I'm out in the Finger Lakes. I own 5 multifamily properties and looking to add more. Looking also into self-storage and bidding on some properties right now. So looking to connect with similar people. Thanks.
Awesome. Keep up the good work. Maureen. Oh, we can't hear you. I can see you talking, but I can't hear you. It's okay. If you want to figure it out, we'll come back to you. No worries. Naftali?
Hey, my name is Naftali. I'm pretty brand new to this. I go to Syracuse University, and I'm a logistician officer for the Army.
Okay, awesome. And then Rob.
What's going on, everybody? My name is Rob Riley. Work and live in Syracuse, New York. Just bought my first residence. It's a single family. Bought it from Dante or with Dante. And I don't currently own any rental property, but looking to possibly buy something in the Baldwinsville or Liverpool area. Yeah, that's it.
Awesome. Nice to see you, Rob. Steven.
Yeah, hey guys, I'm an investor and agent for investors. I have about 3 construction projects going on at once. One's a 4-unit with a restaurant down in Warren Street, and looking to cash out refi, and love real estate. And good luck to everybody.
Awesome. Dave, do you want to go ahead?
Yep. Dave Ravis. I'm from the Syracuse area as well. I'm with Charter Communications and Sales. I don't really have much experience with real estate, currently looking for my first property. And I'm definitely eager to get a lot of insights out of this class tonight.
Awesome. Thanks for joining. Anyone else that didn't go that I didn't call on, please feel free. Go right ahead. All right. Sounds like we got everyone. Okay. DJ, do you want to go ahead, let everyone know what's going on tonight, what the topic is, and our change, or did I miss anything?
Yeah. So first of all, certainly we also, Dante, I think before we jump into that, want to just quickly mention a way for people to communicate. So for everyone that's on this, I think we should hit that now and also at the end. Do you want to just touch base on that quick before I introduce TJ?
What's that again? I'm sorry, say it again.
How we're going to communicate, Dante.
Oh, yes.
After the meeting. Yep.
So after the meeting, we're going to we're going to give you an update on what Victory Capital Group is up to. We also, by request for you guys, we have a Facebook group that we have that you guys can join. You guys can communicate, you can network. If you're looking to buy deals, tell us what type of deals you're looking to buy. If you're looking to sell deals, if you have any good blog posts that you've read recently, podcasts you listen to, books, you can throw that out there. And on that page, I'm going to put the link over in the chat, so you guys will have that available to you as well. And DJ, I apologize if I missed anything. Go right ahead.
No, that's exactly what I was looking for. We just want to provide a means for everybody to communicate when you're in this group and participating on these calls. So originally tonight we had scheduled John Paul Kilduff. John Paul's a guy who's completed over 100 deals. He had something come up out of our control. It was a bit last minute. So in the spirit of being good investors and knowing that deals can also take a turn on us, we're going to pivot. And staying with the initials theme, you got DJ. I was going to bring in John Paul, who goes by JP. Now we have a guy named TJ. TJ Cremeans is in a last minute pinch hit role. And he also knows the Syracuse weather. He's from the Chicago area. It's a guy that I've done an investment with. He's doing some syndications. So what we want to do is have TJ introduce himself, kind of talk about his journey a little bit. It's always good to hear how people have gotten started in this business. And what we're going to do is we're going to talk through some of the syndications that he's done. So for those that are interested in that piece, and while we do this, we're also going to relate it to some of the people that are doing single family, maybe duplex type rentals and things like that. So we're going to make sure we have some content for everyone. But with that, TJ, I know I saw you on earlier. Are you there? And can you give us an introduction and tell us a little bit about yourself?
Yeah. Hey, I didn't know I was following John Paul. That's big shoes to fill there, man. No,
I didn't tell him that when I called him.
We set high bars, very high bars here. So
yeah.
You got a lot of eager people. So
that's funny. No, John Paul's a great dude. Yeah. Hey, thanks, Dante and DJ. Thanks for having me. For everyone else, my name's TJ Cremeans. I am multifamily syndicator. I'm actually from the Chicagoland area, live in Southwest Michigan in Kalamazoo. So you Yankee fans, I'm from where Derek Jeter grew up. So there's that going for me. I've been in real estate now for 7 years. I've been actively flipping and in multifamily for about 3.5 years now. Last year, was my biggest year by far. I sometimes feel guilty saying this when I was watching businesses around me I mean, they got hurt by the pandemic, right? We had our best year ever. So we, in the spirit of that, we're able to use that, and a big component of our company and what we do is a give back, right? And so no better than having our best year when times were tough for a lot of people. So, which I do think is very important in your core values in your business, to have some sort of community give back for each deal. So I focus primarily on multifamily now. My wife handles a lot of the residential stuff. I'm looking in all of the Midwest, so I focus a lot in Illinois, Indiana, Michigan, Ohio, Tennessee, and now looking in Georgia. Sorry guys, but North Carolina and Texas and Florida. So I'm trying to go all over, targeting markets that are cash flow, depreciation, anything and everything that's going to pay my investors what they're looking for. So I'm hoping to bring any sort of value that any questions you guys have, I'd be happy to answer. Hopefully I bring something of value to each and every one of you guys, and go from there. So
awesome. And real quick, in the chat, I just threw in there, TJ's been a guest on my podcast before. So if you guys are curious about listening to his episode, I put that on there as well. And even being able to connect with him, we'll put that info in the chat as well. DJ, you can go right ahead there.
Yeah. So TJ, you're starting the industry. You actually, before you started investing, you had a link to the industry. Talk to us a little bit about that and how that kind of launched you in the direction that you've taken now.
Yeah, so I started in real estate kind of in a weird way. I was in my family's corporate business. I was in corporate sales for a large battery manufacturer, largest in the country, that my family owns. I got out of that, didn't know what I was going to do, and ended up interviewing for a title insurance job, and did not get it. I was looking for a residential sales rep position. And the guy called me up and said, hey, the job you just weren't right for the job. We're going to find you something within the business because we can definitely use you. And I thought that was just kind of smoke and mirrors. Ended up about 3 months later getting a phone call from him saying, hey, I've got this commercial position for you. When can you start? And so I started in commercial real estate as a commercial title insurance agent in Chicago. My wife and I picked up everything we were doing in Ann Arbor and took off to Chicago. My primary focus was working with investors, lenders, developers, attorneys, anyone doing real estate throughout the country. My job was just to connect with them and to bring their title insurance, their deals, whether they're buying, selling, developing, whatever it happened to be, into our office so that we can control the title portion of it. So I got to see everything from $1,000 lots in Chicago to $400 or $500 million wind farms, through Indiana and the thumb of Michigan. So it was everything in between all of that. And I fell in love with the multifamily part of it.
Yeah. And I definitely encourage you guys also, I'm keeping an eye on the chat. So if you have questions, pop them in there. If you have questions, feel free to interrupt. We want to make sure everyone's understanding everything that we're putting out there, and that everyone's also benefiting from what we're putting out there as well. So TJ, you told us where you're from, kind of what you were doing before. Where did that lapse into real estate? So talk to us about, being a regular person working a job and how you made that transition to real estate investing.
Yep. I mean, the kind of corny story was my boss pulled me aside one day and said, don't be stuck in this rat race. There are bigger things out there for you. Look at other opportunities, which I found very odd. And about 2 weeks later, he ended up passing away. He was my mentor, kind of my guy in the business. And so I kind of lost the love of what I was doing, but took his advice. I got into property management, project management, and third-party brokerage. And my dad called me up one day and said, I joined this crazy thing called Fortune Builders, which is a large national networking group. So I have no idea what the hell I'm doing, but if you're interested in joining me in Chicago one weekend, I'm coming in and let's go. And I went there, I drank the Kool-Aid, fell in love, and got into real estate the the very next week, I put together my my business. My wife and I decided we were going to get into, you know, flipping with zero, and I mean zero intention on ever owning rental properties. So it went from flipping to small rentals to large multifamily pretty quickly. So.
Yeah, so TJ, the direction you're taking now,
yes,
versus that initial, so now you're into the syndication piece. Just the differences between your experience with the single family homes and why the pivot to syndication.
Well, there was that step right in between, right? Is finding, we had a single family rental, then a duplex, then a quadplex, and just, I joke about this. My wife thinks she's Joanna Gaines, and I would love to be Chip Gaines's friend. I think that it would be a lot of fun, but it's fun and it's sexy, right? But it's just, I really like on the first of the month getting a nice paycheck. And so we were kind of pivoting from that flip game into the rentals, and I went into 2019, December 2019, in Vegas. Went to a seminar. The idea of learning how to maybe scale up and do like an 8 unit, right? And that was my goal. I left the seminar with the idea to buy 50 units, and last year went big into to syndication and ended up with 232 units, all in 1 year, doing the syndication game. It is a heck of a lot easier than I thought it would be. It is not easy by any means, but with the right people behind you, with the right systems in place, with the network that you're building through through stuff like what you're doing right now. I mean, meetups, just different events, different real estate groups. It really helped perpetuate the growth that we are looking for. It's a heck of a lot less emotion. It's a lot of business. So for me, I was getting out of the single family game and the residential game. I was just finding that it was very emotional, right? It was either people that were going through, you know, a divorce or probate, or, you know, they just lost their mom or their dad, and they're looking to sell their estate and pitching to people in foreclosure. And it was just a lot of emotion, right? And I didn't mind it so much, but it was starting to take a toll on myself. And I had to figure out a way to get out of that funk. And multifamily real estate was 100% the best choice I had made, jumping both feet in.
So talk to me real quick. What made you want to make the switch from flipping houses, the smaller stuff, to the larger space? I mean, that's no easy jump. There's a lot of people in here that are looking to, get started in the smaller space and, graduate their way up. What was the reason that you wanted to make that switch?
Well, so a lot of it, one of the biggest things with regards to, investing is having the capital, right? Being able to have a network or having your own personal liquidity to be able to purchase bigger projects. And I was flipping houses that were bringing, I was raising $300,000-$400,000 to flip houses. And I was thinking, I can do it. I'm doing this and I'm making good money at it. But what if I took those same investors, those same private money guys, and bought something that's going to continually make money, as opposed to just a one and done? And so I had a conversation with them, one of my guys, and I just said, hey, if I got into multifamily, would you follow? He said, absolutely. So, after analyzing, Lord, I mean, you guys know, hundreds of deals, it seemed like, I started to get a feel for what I was looking for. Was I looking, value add, stabilized kind of thing? I found kind of the niche that I was looking for, and here we are now. It just made a heck of a lot more sense numbers wise, a lot less headaches, right? If you have a single family house and you lose a renter, you went from 100% occupancy to a 100% vacancy. When I buy a 48 unit, I lose a tenant. I might lose $600-700 and cost me, a couple grand to turn the unit back over, but I'm right back in it in 30 days with a new renter that, is paying a higher rent. And so there was a lot of advantages we saw. And then having that network available made it very, it made it easier to transition from smaller multifamily, the duplex, quadplex, into the larger multifamily.
Yeah, definitely. And, I just want to touch on something you said there with, you had to analyze hundreds of deals, whether you're looking at duplexes, you're looking at, 100-unit buildings, it's the same thing. You're looking at a lot of deals. I mean, a lot of guys here that are looking at those smaller properties, especially when I was investing in those smaller properties, is I would continuously look at these properties, analyze them, and just figure out which ones made sense and which ones didn't. And offered based on the numbers, not what someone was looking to actually sell the property for. So TJ, I know we can relate to this, especially, these last couple of weeks, DJ and I have been making offers. How often are you offering below what the asking price is on a property?
Every day.
Every just about every time, right?
Yeah, every time. I mean, I think, as you get going, right, there's a decent enough formula to come up with I guess a generic formula to come up with a max allowable offer price, right? And then it has to fit your criteria. I mean, because everyone's going to have a different game plan, exit strategy, funding plan, funding structure, the whole thing. So, one deal for me might not be a deal for me, but it could be for you guys, and it was, it's finding those deals, evaluating a ton of them. I was finding, there's a lot of nasty stuff out there, and I'm not opposed to getting my hands dirty, right? I mean, let's get, if we're going to get a property and we want to buy it, I mean, I made an offer on Sunday for a building that was 60% vacant. I don't mind that. It just has a new evaluation, right? I think my favorite quote that one guy told me was, I don't buy on perform is pretend. And I stopped playing pretend when I was 8 or 9. And so, I look at real numbers, right? And that's the business side of it, where in residential, there's a lot of emotion. So this is just cut and dry. I mean, it's a business, it's what you're doing, you're performing at, and I have an offer that I feel comfortable based on the liability and risk that I'm taking.
Right. Yeah, most definitely. And I think I say it because I want to point it out to people that the asking price isn't the end all be all. And if you have to submit 10, 15, 20, 50 offers until you get a property, then so be it, because you're going to buy it the right way. If you're working with, if you're in the smaller area, you're working with an agent, or if you're in the larger area and you're working with a broker, when you're in the smaller area, the agent is going to be more on your side because you had that co-broke. But as you get to the larger area, the same broker represents both sides sometimes, and you can't always listen to them. You need to really know what you're doing, focus on the numbers. So don't be afraid, guys, to offer under what the property is valued at, especially if it's been sitting for a while. I mean, that's just kind of asking for it because it's not worth that. And you have to make the numbers work, not by forcing the numbers to work, but putting the numbers into what needs to be done. And if that means offering 20,000 less than the property is listed at, so be it. You might piss someone off, but who cares? But at the end of the day, the worst they can say is no.
Yeah. Dante, I think you and I talked about it, and DJ, you and I have definitely talked about it. My first deal that I purchased, on that point, I won't go into it unless you want, but they were asking 2.7 on a 48 unit deal, and I bought it for 2.2.
Yeah, there you go.
So
it's a prime example.
Yeah. And to that, there was a lot that went into that whole negotiation that I, to this day, use the exact same thing I did on that on every offer I make. Sometimes it's looked at like, I'm goofy, but I send a letter just explaining who I am, what I am, and why we do what we do. And I think, playing on the fact that commercial isn't emotional, it definitely makes me a person, and they see that, and I think it brings a value to them that, this is, I might have a name in a business, but I'm also a real person doing real things. And I'm not just a guy that's coming in for a bunch of profits. I'm a for-profit business for sure, but I'm a real person doing real things. And I want to take care of the people that they've been, taken care of and pass it on into good hands. So.
Yeah. And I mean, in my office, you guys can't see it right now, but on one of the walls, I hang every single offer or LOI that we put on a property, DJ and I, just to kind of gauge where we're at and how far along we're going. And not one of those LOIs, so letters of intent are what they are called in the commercial space. You submit that before you have a purchase contract. It's non-binding. And every single one we submitted has been under the asking price. I mean, there's one up there that's $900,000 under the asking price. And I, called up the broker and I said, hey, so-and-so, here's where I'm at and here's why. And he told me, he's like, listen, if I was in your shoes, I'd offer the same thing. I think the asking price is kind of crazy, to be honest. I don't think it's disrespectful that you're putting it out there. Do I think you're going to get it? Probably not. But has it happened? Yes. And he also explained to me, here's what we'll do. Once we have all those offers and we're looking at them, and this is kind of a little tip for you guys, they're going to compile all those offers and they're going to put them in a file on their computer. And when they have another like asset that comes up, so this was a 48 unit property, when another 48 unit very similar comes up, they're going to go back to that property. They're going to see who wrote the offers and they're going to say, all right, let's send this new property out to these guys because they're active, they're submitting offers, and we take them serious. The guys that are submitting 2-3 million under the asking probably aren't going to get the call. But he's like, listen, Dante, next deal that comes up, we're going to pull your name out of that hat and we're going to send you these properties. Some of them we get outright no's from, some of them we get outbid on, and some of them we get counter offers on. Like one property, DJ and I, we submitted an offer on. It was, I believe, $450,000 under the asking price. The guy didn't say no. He just came back with, hey, this is where this is where I'm at. Can you do this? And countered it. And, we weren't in love with the property. If we're not in love with the property, we'll write an offer, but it's going to be based off of how we feel about the property. It was an older asset. It wasn't really what we're looking to go off of or go after. I wasn't in love with the deal. So if I'm not in love with it, I'm not going to be in love with the number that we want to be at. So we're going to step that back. And if we get the deal, it's a great deal at that number. But anything over that, we're not really looking to go into. I mean, how often do you have that happen, TJ?
Yeah, and it's a great point. And I think I just want to slip something because I don't want anybody to miss this. TJ brought up, I think, two things that are really huge, especially for our new people. One is he talked about teams and teams that he's worked with. And you're not going to be successful in this business if you're not building your team. So for you people that are new, big sound piece of advice is, think about all the people that you need for to whether you're doing a flip, whether you're doing single family rentals or multifamily. Teams are huge, and you really have to have a focus early on building your teams. And the other one is direction. And I can say this one from personal experience. My first few years in the business, I jumped around a lot. Looked at Airbnbs, looked at flips, looked at rentals, doing the BRRRR strategy, and so on. And you get traction when you pick a direction and go. TJ, anything to add to that?
Yeah, I was just telling this story. I was actually on a webinar yesterday, and the whole team category got brought up, and they asked, who should I have on my team? And I said, well, kind of jokingly, I said, I want an accountant because I want my accountant's going to keep the most money in my pocket, right? I want an attorney because his one job is to make sure I don't go to prison. I want a good broker who's going to continue to build a network that's going to find me more deals, and you need investors, right? And through that, you're going to find as you build that team, that's going to start to focus and help you find kind of your niche product that you're looking for, right? And in that niche product, you're going to be able to then find that true direction as to where you're going to go. And sometimes those people just lead you right there. I mean, for me, I very quickly saw that I wanted to do a lot of work. So I was buying value add properties, meaning there was either rents were lower, there was a lot of vacancies, there was a lot of turnover and updating and sort of renovation that needed to be done. I wasn't afraid of that I came from basically flipping, right? Or a mixture of all three of those, right? And so I took the value add approach where I was buying at a high cap rate, retrading it at a lower cap rate, and taking that equity and rolling it into another deal, being able to pay my investors from day one, being able to provide good returns for my investors, buying a stabilized property. I know a ton of people that do. I've bought a stabilized property myself, but in the stabilized property, there's a whole new project, right? You're not having to do a ton of rehab. you're managing costs that are a little bit, that are actually stabilized. You might be negotiating vendor costs down a little bit to lower those expenses. You might, add a utility charge to the rent to kind of increase that income to offset those utility charges. There's a lot of different nuances to stabilize that aren't necessarily in the value add, or maybe are, but they're not. It's not as prevalent, I guess, to the deal as the value add is, where you're working every day to get new rents in place. Running background checks, credit checks on everybody. You're doing rehabs on the units. You're fixing up the aesthetics of the outside. There's a lot that goes into it, and that's the niche that I found. So.
Yeah, and I just want to cut in there real quick because I've got one thing I want to go back to, and then I got a question in the chat, and I see DJ, you had something. Going back to the offer for you guys that are looking in the single family duplex, small multifamily space. I know where a lot of you guys are coming from. My initial plan was I wanted to take over a whole street in Syracuse. I wanted to buy every property on the street and bring the street up. And that was the initial plan. So I actually bought a duplex on the street. Then I was in talks with the neighbor next door, the neighbor on the other side, the neighbor across the street and down the street. And I was looking for every single property on that area. And there was a single family for sale, and it was up for a little bit of time. It was for like $75,000. Nice house, 5-bedroom, 2 full bath. It was decent size. And I worked my way backwards. So I figured out how much I think it's going to be worth, how much it's going to cost me to renovate. And then there's my acquisition price with a little bit of buffer room. So this property was offered at $75,000. I came in $35,000, and the agent's just like, no, this isn't going to get it done. You're crazy. I don't even know who you are or whatever. And I said, listen, just present it. $35,000 cash, no contingencies. And he's like, all right, fine. I'll present it. The guy came back at like 45. I said, okay, I'll do 42 and we'll call it a day. The guy slept on it. We ended up doing 42,000. I say all this to say, okay, some things that stand out: cash. Obviously, in the large multifamily space, it might not be the option, but cash is king. That's very true. There's no appraisal. It was quick. We were able to close in 30 days. No contingencies. So I didn't do any home inspections, radon tests, mortgage, anything like that. So it was super clean. And I was able to go through and get that property for 42,000. My plan for the property: I could have burnt it. I could have flipped it. I could have done it as a single family rental. And so I renovated it, and I went for the BRRRR approach, except I left out one of the R's, and that was the rent one. I'm actually in it right now. I liked it so much, I ended up moving into it. So, that's the house I'm in. It went from this $42,000 boarded up house to this $150,000 beautiful house, with granite. And I'm not saying that to brag, but just tell you, like, I came in really low from that offer, and, he was shaking his head, nodding his head. No way, you're crazy. Ended up getting accepted. And because I kind of built that relationship and showed that agent that I could close the deal quick with no issues, he actually thought of me on the back for some other deals. So he brought me 2 more deals, and now a 3rd deal that doesn't work for me, but I pawned it off to my clients. I sent it over to him. Hey, I got this great property. It's off market, and I was able to close all the deals. So a few things to take away from that. I offered below asking by a lot because of what made sense with the numbers. I used terms such as no contingencies and cash to make a good offer. I was able to BRRRR it because I used the business plan in place. I was also able to woo the agent and build a relationship to get more deal flow from them. So there's like kind of a lot of takeaways there. Real quick, we had a question over here. TJ said he's found his niche after looking at a lot of deals, but how do your funding partners influence the type of deals you go after? So it sounds like funding partners being your private investors or your capital investors. Do they have a say or influence those deals you go after? TJ, do you want to touch on that?
Yeah. Hey, Dante, I want to jump in right here because this actually ties into my question. And TJ, I think to kind of lay the baseline for this, if you can talk about the difference between some of your gap funding you get from private investors doing a flip versus the syndication piece. Talk about risks versus reward. And if you can kind of run through that for us, and also answer this question of, how these funding partners influence. What's the attraction for a syndicator? What's the risk?
Yeah, I mean, I guess to start off then with the private money, for those of you that don't know, it's you guys, right? It's you guys right here that have, you know, maybe depending on the deal, 20, 30 to 50 to 100 plus grand, you're getting a lien position. So you're getting a promissory note, you're getting a mortgage on the property. Second position usually to either hard money or maybe even first position if you're the only money in the deal. So you're getting a lien on position, which is guaranteeing you of sorts that you're going to get money back out of the deal, right? Because when you go to close on a property and sell the property, all liens have to be removed to have clean and marketable title. So if there's a lien on the property, for instance, for this sake, DJ, you're funding my property, right? The title company is going to go to DJ and say, hey, has TJ paid you in full to the terms that are agreed upon? If so, here's a lien waiver signing off that he paid you in full. Now the property is marketable, and the buyer gets to take the property with no issues, no liens, no anything on the deal. There's usually agreed upon terms, right? So whether it's 8, 10, 12, 15, I've done private money at 20%. I needed to find 100 grand in literally a day, and went to my network and just literally said, name the price for 100 grand, I need it. They said 20%, I gave them 20% for 6 months, bought the property, and cost me a ton, but we needed the deal. Otherwise we lost about 80 grand on the deal. Then you go into sort of the investor role. So it's a little safer. There's guaranteed returns, right, in the PML, but in the investor role, for me, there's a larger upside. Usually that upside comes with, in a syndication, there's a couple different models. One has like a preferred return, which is similar to your promissory note saying 10, 12%. You're going to get a preferred return of X, whether that's 6, 7, 8% returns. But what you're also going to get is, and upwards, I've seen upwards of 10, 11% returns, which I thought was crazy, but they're there. And then usually you're going to get cash flow equity on the back end too. So you're going to get your monies back to you before the general partners, the owners, get their money. And when you get your money, then you're going to split the cash flow 70, 30, 80, 20, 75, 25. That's all going to be agreed upon per deal, per fund. My strategy is not much different than that, but it's you become an equity partner in the deal. You're considered a limited partner in the deal, so you don't get say in the property. You don't get control of how the property works or is managed or any of that. You're basically buying into what I plan on doing to the property and my experience, my portfolio, and my track record of paying the investors. For instance, I've got a deal that we're closing on literally tomorrow. It's a 24 unit deal. My investors from day one will get 70% of my equity. So every quarter, every month that comes down, I'll take income minus expenses, take that NOI, and they get 70% of that. I get 30%. And then it goes on to the next quarter and the next quarter and the next quarter. And the deal with syndication is those payments are kind of considered like interest only, right? There's nothing to principal. It's dividends essentially paid to you. Your monies is still in there. So if you gave me $100,000 and for one quarter I gave you $1,500, that $1,500 doesn't come off that 100 grand. It just is your money for loaning me for being an investor in the deal. Right. And then when I bring the value to the property and I increase the value of the property, take the cash out of the property and pay you back. Most of the time in a syndication, you're done. You're out of the deal. Thank you for your money. See you later kind of deal. Please come and invest in my next one. But what I do is I actually keep the investors in for the eternity of my deal. So they will make money in perpetuity. As long as I own the property, they will continue to make money. But instead of them getting 70%, they'll get 20% profits on my cash flow for as long as I own the property. And then when I go to sell, so say maybe I sell in year 7, the investor pool on that deal will get 20% of the profits on the back end as well. So for easy numbers, if I make $1 million on the back end, I'll take my 800K as my profit as the 80%, and they'll take their 200K, split equitably between all the investors in their position. And then now at that point, they've made all their money. They've made their interest. They've got all their initial capital back. They've made interest on money that's already returned back to them, and they're getting a check in the end for profits for investing in my deal. So there's a big upside to that, right? Because you're going to be making long-term money on money that's already returned back to you, where if you're a PML, once you get paid, you're done, and you got to hope you get in there. There's a lot more risk because if the market crashes, the market goes down, it's 100% dependent on that ARV. So if you don't, you're after repair value. So if you don't have enough equity in that property to pay that private money lender back, you're struggling. But if you're in an investment deal and I can't pay you your money back on year 2 or year 3, you're just going to continue to make cash flow. You're going to continue to get paid something until I can give you your money back. Private money, it doesn't work that way. There's probably not the cash flow unless you put a renter in there, and your exit strategy, like Dante was talking about, is solid, where you have, you could rent it. You can apparently Dante just moves into his flips. You can
zero income.
Yeah, zero income. There's, you can rent the property, you can sell it, and usually you those are your 2 strategies right there. But the private money lenders are protected. In investment wise, it is a little bit more risky because there's no guarantees or promises, but it's backed by a cash flowing asset. That is, if you're doing it right and buying it right, should be appreciating and should be growing in NOI as you continue to perform in the property, get the rents up, get the expenses down, and make all your capital.
Yeah. And Marianne, I see your question here. I just want to make sure it's answered. You said, how much do your funding partners, I'm going to assume you're meaning investors or private investors. Is that correct? Okay. It influences the type of deals you go after. So like last month, we talked about private investors. Really it's going to depend on what you're presenting. So are you going to give them their money back right away? Or are they going to in 6 months, so quick? Or are they going to stay in it for the long haul? So like a project I did a mix of private money, hard money, and my own money. And I had the deal and I just brought it to these investors and said, who wants to, take a crack at it? And one guy, raised his hand and said, I like it. It sounds like I'm going to get my money back within 8 months at a decent interest rate. So he was interested in that. And then for, going over to like the syndication model, where it's going to be like a longer play, the investors don't really have say in it, but the type of investment you do is going to attract different investors. Sometimes if you're doing like a core plus deal, you're really not going to have super high returns. So maybe that's someone that wants to take a lower risk, or you have a value add deal that does have a little bit more risk. Therefore it has a little bit more reward. So you're going to attract different investors in that aspect. And then we won't even get into it, but a blind pool or blind fund is literally, you just trust the syndicator or this private investment group so much, you just give them your money. You have no idea where it's going or what kind of investment it's going into, besides it's going to be multifamily in this market. They don't have a specific property. Does that kind of answer your question for you? Okay, awesome.
Dante, to add to that, I mean,
yes.
To my experience, my investors didn't really lead me one way or the other. I found these properties. I found kind of my niche. I told them. I've had investors tell me no, that we're private money lenders, right? Yep. I've also had repeat investors that are in 3 of my deals that I found another deal. They had capital. They said, hey, I find more deals, whatever. I sent them a deal and they're like, don't like it. And so I think there's a level of sophistication that comes with being an investor in a syndication or into a fund. I think there is a little bit more knowledge, I guess, that you need to know about the deal, about the syndicator, about the market, right. And feel comfortable. You're really, honestly, even though it might be tied to an asset, you're trusting Dante, TJ to perform, because there are no guarantees. There are no real promises with it. You're just trusting them that your money, that they're going to be a good fiduciary to your money. They're going to execute the game plan that they told you, and in return, you're going to make good money doing so.
Right.
And so that, to that point, then it's all based on the relationship, 100% on the relationship and the level of comfort your investors or your private money lenders have in you and the assets that you're investing in. And that could be the class, it could be the asset itself. I have some investors that love multifamily that all of a sudden got into self-storage. They want to get into self-storage. Now I'm looking at some self-storage stuff.
Right.
So that's what they lead me to. But they don't get much say with regards to what I go into. They just get a choice whether or not they want to be in it or not.
No, yeah, I love that. DJ, you have something real quick?
Yeah, and TJ, so you're basically talking, back to that risk versus reward, right? So a little less risk if you're a private money lender, lending to somebody who's doing a flip because it's backed by real estate, you get that lien position.
Yep.
There are no guarantees on the syndication side, but there's more upside. So talk about the upside. What are some of the numbers that make a syndication deal attractive to a passive investor?
I mean, last year my portfolio was anticipating a 10 point, on average about 10.2, 10.3% return. My investors, all together, it's trending to about a 14% return. So there's that. You're going to get paid depending on the structure, but you're going to get paid on an asset that's performing, right? And you're going to continue to get these checks and all of that. And the upside on the kind of the backside of it all is you're usually getting the growth. You're getting your portion of the growth in equity and appreciation over 2, 3, 4, 5, 6, 7 years, depending on how long it is, to continue to make money when your money's already returned to you. You might already take that money and put it right back into another deal, and it's still making you money. Yep. While that money is into deal 2, deal 3, you might still be getting money from deal 1, which is a great problem to have, right? I think the joke is like, here, take my money and go find some friends, right? And those friends get along, and they bring more friends along, and soon enough, you've got enough friends to do whatever the hell you want to do with, right? And that's the game plan. I mean, is to go out there, find investors, find assets. They're going to continue to build long-term wealth moving forward for you, the limited partner, the investors, and me, the general partner, the ownership in the deal. So,
yeah. Want to head back over to the chat box real quick. We had a few more questions. This one's going to be more for the Syracuse natives. A question came, what's your advice on buying properties from the Syracuse Land Bank? I see the properties need a lot of work, but what's your take on them as an investor as well as an agent? So here's my take with the land bank properties. And for those of you that don't really know what they are, they're basically really distressed assets in not the best areas of Syracuse. So when I say distressed and not the best areas, I mean, you can buy a house for $1,000, for $5,000. They're very cheap because they need a lot of work. My take on them though is they take a lot of work, and there's a lot of specifications you have to go by with the land bank to make sure they are correct. So for example, I've got a buddy who bought a property from the land bank. He called me and said, hey, can you sell this thing for me? I said, why are you selling it? It's a rental. The land bank is forcing me to sell. They don't want me owning it anymore. Didn't give him rhyme, didn't give him reason. He had to sell the property. He was forced to because the land bank controlled the property even after they owned it. Another aspect is, he went in and bought this duplex for $9,000, and he was planning on putting $100,000 into it, but the land bank will actually make you renovate those properties to a certain finish, to a certain degree, with sometimes even certain contractors I've heard. And he went 50,000 over budget and blew the project because he had to go by their guidelines. My thing with those projects is there's so much to them, and they're not in the best area, that I can't imagine some people would want to put those into their rental portfolio. I know some people who have been very successful with land banks as well, but there's so much risk, and you'll get a lot of reward because of the amount of risk. So it's just like anything else: low risk, low reward; high risk, high reward. I tend to stay away from them. A majority of my clients tend to stay away from them just because of where they're located, what work they need, and how minimum control you have over the asset. Is my thought there. And again, guys, if you have questions, keep popping them in the chat. Another question, TJ, I think this is going to be more towards you. How would you get the confidence of possible investors when you have no experience in syndication? How'd you go about finding investors even when you're flipping? So on that first deal, I think you already said it, how you already had private investors that followed you over, but I'll let you touch on that.
Yeah, I had private investors that came on over, but it's kind of smoke and mirrors because I had 19 investors on my first deal. 17 of them I never met. Out of those 17, 15 of them I still haven't met. So to the confidence point I'll go back to December 2019 when I came into the seminar. I had a piece of advice that was given to me that made me realize that the raising the money, if you have the confidence to go out there and talk to people about money, good money finds good deals all day long. If you have a good deal and you find even one person, Dante, DJ, myself, I mean, I'm not trying to take the floor here, one person that believes in that deal, that can tell one person, I know it sounds corny, it's exactly how it happened. I had two investors that believed in the deal, that believed in me, told two people. Those two people told a couple people. I had to go out there and make a bunch of phone calls to everybody on this phone. I'm downstairs in my basement right now because it was loud upstairs, but I have a board in my office, at my home office. I made 357 phone calls to people to raise $930,000 for my first deal. It was very tiring, made me wonder if I was ever going to be able to do this thing. But the flipping side of it made it a little bit easier because I built up that network of people that knew real estate, that kind of backed my play and knew where I was going, even though I was faulty with my execution with regards to how I bought the deal. They believed in me. You have to tell everybody, and anybody what you do. The girl that cuts my hair is so obnoxious, or she thinks I'm so obnoxious. I'll tell her every single time I'm in there, I'm a multifamily real estate investor. If anyone has any property, sell it, bring it my way. I'll leave my card. I'll come back and leave her another card. She still has all my cards sitting there, but one day, hopefully somebody will grab it. I tell everybody, man.
Right.
That builds up my confidence too, because, you don't get too many, second chances to talk to people. So my elevator pitch is down now because everyone got to hear it for the whole length of me building my network. So and I think it starts too, again, this is corny, but you have to believe that you're going to be able to do it too. If you don't have the confidence in yourself that you're going to be able to do it, you're obviously going to lack that. And the important piece, going back to the team, finding people like Dante and DJ that can support you. If you're going to bring a value to them, they're going to work with you, right? They're going to JV with you. So if you're learning and trying to get into the syndication world, you might find a deal. You might not know what you have. You bring it to them. They think it's a great deal. I mean, I'm not going to speak for them, but if it was me, I bring you in on as a partner. You found the deal. Hey, let's go. Right. I've got my systems in place. So you don't need to have all the tools in your toolbox right now. You need to have what you're confident and comfortable with, and find other people that can help you execute that game plan until you build up all that confidence. I had 3 partners on my first deal. I have no partners in any of my other deals now. And it just, every day was learning more and more and more. Podcasts, audiobooks, articles, you name it. I was listening to it, reading it to learn about how to do it, where to do it, when to do it. And here we are now. So, I mean, not to be like braggadocious about this, but this is one thing that I go back to every single time when I think about this. I started investing 3 years ago, full time. Within the 7 years that I was in real estate or have been in real estate, I had $12 to my name at one point. $12. I had no real estate knowledge. It is 100% possible to sit there and go from flipping houses, wholesaling houses, buying your first rental to buying a 50 unit, 60, 70, 80 unit deal. You just have to build up that network. Like guys like Dante and DJ, who have become family to me. And I'm honored just to be able to chat with them when I get to chat with them. So.
Awesome. I love it. Anyone else, like I said, if you have questions, place them over in the chat. Also, if you guys get an opportunity as well, put in the chat topics you'd like to hear about. We want to be able to give back to you guys what you're looking to learn and whatever that is. I mean, I'm sure some of you guys get tired about hearing about syndication. I'm sure some of you guys get tired about hearing about like lending criterias. We want to give you something fresh each and every time. So if you guys think of something throw it down in the chat box, message me, let me know what it is that you guys want to hear about. DJ, did you have anything else for TJ?
Yeah, it's just when I explain syndication to people, there's always that discussion on forcing appreciation, right? When you're flipping a home, that's what you're doing. You're buying at a discount. You got to figure out your repair costs. The big difference, aside from having multiple investors, is the institutional financing that you're leveraging there. Versus maybe a hard money loan or trying to find a private lender. You're really not dealing with banks when you're doing single family stuff. Maybe as you go on, you get a line of credit, something like that can help you out. The big difference between the two, and TJ hit on it earlier, when you're doing a single family home or duplex or something 4 units and less, you're looking at comps and you're limited by those comps. When you're doing these multifamily properties, there's this thing called cap rate. And TJ, you talked about higher versus lower cap rates. And I just thought that was worth elaborating on a little bit, because these properties are valued based on the income. So the returns can really be phenomenal. Whereas when it comes to single family homes, you are limited by the comps in the area. So, market appreciation and stuff, while it does have an effect on multifamily, TJ talked about value add in the play on comps there. So TJ, can you just elaborate on that a little bit?
Yeah, certainly. So, a cap rate for anyone looking into it is if a property is selling for $1 million and it says it has a 10 cap, that is, if you paid cash $1 million, that property will make you 10% on that money. So every year you will be making $100,000 year one, your anticipated returns would be 10% or $100,000. Buying a higher cap rate means more often than not that there's more work to be done. There is a value add component to it. So it is not up to market standards, whether that's the units themselves, the market rent, the building. You're buying with a little bit more risk because there's a little bit more work or often a lot more work that has to go into it. Where if you're buying at a lower cap rate, it is more of a stabilized deal. So you're buying at a 10 and retrading it at a 7. That's a stellar opportunity. And what I do with a lot of the investors I go and talk with, to make it very, very simple, if I had $100,000 of income and I had $50,000 of expenses, I had $50,000 NOI. If I bought that at a 10 cap, I divide that by 0.1, the property's worth $500,000, right? If I take that same formula and say I lower my expenses $5,000 and I increase my my income by say even $5,000. So now I have $105,000 of income minus $45,000 brings me to $60,000. Say that market is now stabilized and now I can sell it at an 8 cap. That same property, whether it's 6 months, 12 months, 18 months, divided by 0.08 is now worth $750,000. So by literally lowering the expenses $5,000 in increasing the income by $5,000, $10,000 of NOI change increases the value $150,000. So for the for people coming on in, if you're buying the value add opportunity, know that there's a ton of work that's going to go in there. You're going to have to be turning units, getting market rents on up. So that might take a year, right? So you might have a tenant that just signed their new lease the day before you bought. So you've got at least a year before that unit's ready to be turned over. There's a lot of different strategies with it, but buying a higher cap rate, the game plan should always be for you selling it at a lower cap rate when it's stabilized. If you buy a stabilized asset, you might still have a value add component to it. You might buy it at a 7 cap and still be able to sell it at a 6, but you're just not going to make as much profit on the back end on that equity piece. You're still going to make a solid play, but you're just not going to be making as much profit on the back end oftentimes. So that's my focus, is that value add component, because I don't mind getting my hands dirty, having to deal with tenants and raising the rents. I mean, my 48 unit deal that I bought, my very first deal, the average rents were $615 across the portfolio. And in a 9-month period, the average went to almost 700, and the new valuation on the property has gone up quite significantly from that alone. So that's just kind of my play in the real estate game. I love the value add. I said before, I have a stabilized property. Don't mind it at all, but I don't appreciate it as much as the value add side.
Yeah, it's not your cash cow, right?
No. The one that makes me the most money is definitely that. Actually, my first 2 properties I bought are my favorite ones for sure. So
there you go. Yeah.
So the other thing I want to touch on too. So as a passive investor, I think one of the things that's really cool about syndication is this getting a seat at the table, the communication that I have with TJ. And TJ, your feedback to the investors, it's kind of a unique feature of these. Dante, how are we doing on time? When do we have to wrap up?
I'd say we'll start wrapping it up now because we do about hour and a half, but just give some room for any questions or anything.
Yeah. So touch on that, TJ, and then we'll kind of open it up for face-to-face questions.
Yeah. So I thought it was very important, especially getting the syndication, to have almost too much communication with my investors at times. And so what we do is every quarter we do this. We sit down with our investors, we do a Zoom call. I present my quarterly P&L to them, show them where the numbers are, show them vacancies. I show them all expenses, where our money's going, how it's being spent, what our game plan is, how we fixed the prior month's issues or prior quarter's issues. And we have this conversation with our investors every quarter. And so, DJ, Dante, any of you guys that are investors in my deals would sit down and have this face-to-face as if we were sitting at a round table saying, hey, here's your check for being an investor, right? But how do you feel the project's going? What would you like to see different? A lot of people don't comment. They're just like, hey, give me my money. I'm happy with that. And other people are like, hey, I want to learn, right? I want to see how this is done. I want to ask questions, probe a little bit, see where the money's going, why you did this. So it brings kind of that interactive piece to it. Even though they don't have control in the deal, they get to see why we're doing what we're doing and where their money's going, which I think is important to building the rapport moving forward with them, right? We've got now 13, maybe 14 repeat investors on deals that are at least in 2 deals. And I have probably 7 or 8 that are in 3 and 4 that I can count on that are in 4 deals. Those are my best referrals, right? So having these face-to-face with them, having this communication with them just gives them kind of peace of mind, knowing that their money's safe. It's going where I said it was going, and how I plan to continue to execute the game plan.
Right. Try that with your Apple stock or your 401k fund.
Right. And there's some tough conversations. I mean, I had one time, just candidly, there's a Bill Johnson. He's the Stryker family. I'm sure you guys have all heard of Stryker Medical. Bill Johnson lives in Kalamazoo. He lives about 10 minutes away from us here, but he just bought a new business, and his new business partner is actually a friend of mine. They're mega billionaires here. And I only say that because this is the piece of advice he gave me that I think about based on this conversation right here. I said, when you created your fund and you started your real estate fund, your blind pool that Dante kind of talked about before, it's the best piece of advice you can give me. He said, be prepared to make the mistakes and be doubly prepared to own them and make them right. And I thought, like, how cool, like this dude, like he just kind of took it on the chin, and then he just kind of punched right back and said, hey, I got hit. This is what happened. This is how it hurt us. This is what I learned from it. And this is how I plan on executing that and changing that. And so I've had uncomfortable conversations with investors where they felt like it wasn't going as planned. And, we had to have a heart to heart, and we figured it all out. And ultimately at the end of the day, I said, listen, I'm going to try to execute the best I can. I'm going to be a fiduciary to you. We're going to try to make this right. And this is how, and I think we came to an agreement on it all. So it's not always rainbows and butterflies, but it definitely continues to be a character builder and build a rapport for me and my investor core.
Yeah, that's a good word. Well, like I said, guys, anyone have any questions, please go ahead, unmute yourself, whether that's for TJ, DJ, or Dante, whatever you have, let us know, put it in the chat. I'm also going to put the link in the chat right now to our new Facebook group. So if you do want to click that or take that and join that, you'll get updates on, like I said, deals, meetups, or anything else that we're going to be throwing in there. Next month, not sure exactly what we're going to do yet. We very well may have it in person and in Zoom. So it's going to be at my office. Plus we'll have a webcam for people who can't make it in person. Thinking about doing a night on just deal analysis. So we'll analyze some duplexes, some triplexes, and then we're going to possibly break down how we analyze 50 unit building and what we look at to come up with those numbers. So I think some people would find that interesting. Other people would get very bored, I'm sure. So we'll have to weigh it out.
Yeah. So before we get started with Q&A, TJ, you mentioned the Yankees earlier. I see Brian's got a Red Sox flag up. So we need to keep the questions specific to real estate. And the other one is somebody's got a picture of a stand-up jet ski, which is like, that's throwback. I know they still make them, but Mark's got a picture of that stand-up, and I think that's really cool. So
I like it.
With that, we'll open up the floor for questions.
Nothing this month, really.
All right.
I'll throw one out. Instead of, would you say today is it better to start off just with the single family stuff, or would you just jump right into the larger multifamily? I mean, does it matter to you? Do you have to have a certain amount of capital, or I mean, what would be your game plan if you had to start all over today?
Knowing what I know now, I was just talking on a Clubhouse event about this. I would have gotten into investing when I was 18, but it ultimately is going to depend on your network. You're not going to be able to buy you might have all the knowledge in the world, but if you don't have the network and capabilities to raise the money, you're not buying a 50 unit deal. Not to be pompous about it, but like you just aren't. You either need your own liquidity, you're going to have investors and network that's going to be able to support you. So with that, everything's going to be situational. You might find a deal, your first single family, fall in love with it, and never want to go into multifamily ever again. You might find that it's again, like I said in the beginning, you have one tenant leave, you have 0 tenants in. So there's that risk as well. Me personally, I won't buy anything under a 4 unit anymore because I just love the play and I have that network built all up. But if you have the capabilities, I think, and DJ and Dante, I'm sure you'll back this. I've found that it's way less headache dealing with the multifamily properties I have than the single family properties that I had. I don't have as much of a headache and a worry because I'm not worrying about if one tenant's going to be gone or 2 tenants going to be gone. It's just, it's easier. You usually have a third party manager doing it, right? So you have someone else that's handling those tenants. So it's a little less heartache and headache dealing with it. You're dealing with one person and not the 48 people. Or if you have a single family, you're oftentimes not going to have a property manager and you're going to get phone calls. I mean, I tell the story all the time. I stopped being my own property manager when I had somebody call me and ask me how I got rid of ghosts. I said, I hope you have Dan Aykroyd's number because I sure as hell am not a Ghostbuster. And I'm like, listen, I don't care what you're charging me. Take my money and be a property manager for me. I don't want any more phone calls about ghosts. It ended up being a shorted outlet. So yeah. It's all going to be dependent on your network, your capabilities, and also I think I said it before talking about your question, Jose. Actually, looking back, is partner. If you want to be into a multifamily, you don't have that aspect or those tools. Try to find someone like Dante and DJ that you can bring a value to. Ask them what they need or what they don't like doing, because quite frankly, that's what I tell everyone, what I don't like doing. Right. And if they can do that for me, hell, I'll bring them in as a partner. Here, I'll give you 15-20% equity in my deal because you saved me a lot of headache doing the things I don't want to do. So I mean, I hope that answers it. I'll never go back to single family. I just bought a house for my little brother, and that's the last single family house I'll buy as a rental ever again, probably. I just love this.
To touch on that a little bit, I think, Jose, the duplex, the single family is a great way to start because the barrier to entry is a lot lower. It's easier to get in, and that's what's going to kind of kickstart you. Because if I didn't start with the duplex, I never would have worked my way up to where I'm working my way up to. if I could have changed it, I would have directly went to multifamily, but at the same time, I didn't have that availability because I didn't know what I didn't know yet. And getting into a duplex helped me roll over into that. And it's like when people say, trading up, it also really depends on, what are you looking to do? So I talked to a gentleman today who has 64 units locally in Syracuse, and he will not let anyone manage him. He loves managing them. He loves doing that, him and his wife. And, to me, I'm like, I don't ever want to do that. I think it's terrible. And I read a book. I was on my way to speaking to a conference in Florida. And when I was flying in, I read this book called Multifamily Millions by David Lindoff or whatever. And he said something that really made sense to me. He's like, I'm in the business to buy and invest in real estate, not manage it. He didn't want to be a landlord. He never wanted a single tenant to see him. And I get that because I'm the type of guy who I had a lady who was behind on rent, a Christmas ago. And hey, Merry Christmas. I know you got 4 kids and you're by yourself. I'll waive the late fee this month. Well, 1 month of waived late fee turned into 3 months of no rent. She took it and ran with it. I'm a terrible landlord when it comes down to it because I don't put rules in place and enforce them, versus where a property manager was in that situation. I'm sure that never would have happened because that leniency would have got in there. So it just depends on what asset you want to be in. But I think it's a great spot to start in that smaller stuff to really understand it on a smaller scale at less risk and then grow your way out.
Also, I think it's going to depend a lot on your market, right?
Yeah, that's true.
And for me, like a single family rental here in this market, it doesn't, the numbers don't run. If my brother wasn't renting the house that we got for him, the numbers wouldn't work. He's kind of doing a rent to own scenario. And the only the reason he's got the place is it's covering the note. It's appreciating really quick. I couldn't get the rent that I'm getting right now if he wasn't doing what he's doing. Some markets are great for single family rentals. Some markets don't have strong multifamily. Like I've got, there's a property right down the road from our house in a sister city called Portage. Really, really great single family market, really, really poor multifamily. I can't find anything in that city. So a lot of it's going to be market driven. And you might live in a market that just doesn't make sense for a single family. And now you're looking, if you're going to have the headache of buying one property 50 miles away, you might as well have that same property 50 miles away and have 20 units doing it. If you can back that. So that was sort of the game plan for me. I mean, my closest property is about 2 hours away from me. So I get to go see it as often as I want, but to Dante's point, I have someone else that's managing because I'm a really poor landlord. I will make sure that they are. I mean, because the human component comes to it. I like playing bad guy and letting the property manager be good guy, because when it comes down to it, like I'm gonna look at them, they're gonna get puppy dog eyes, and they're gonna walk away with 4 months free rent, and like I'm gonna buy them a new TV. So like it's not gonna be a good scenario for me. So.
Yeah. And another question that came in, Rob, what makes a market more or less advantageous for a single family property? I was talking to someone today. I said, single family, small multifamily is really good in Syracuse, but large multifamily really isn't. And vice versa down south, it's the other way. Reason being, the median sale price for a single family in Syracuse is $150,000. You go to North Carolina, the median sale price is possibly $450,000. Think about how much harder that's going to be to cash flow when you're talking a $300K difference. And, don't even get me started with California, what the difference is there in certain prices where, you find markets like Syracuse. I know Ohio has some good markets. Missouri, I think it was, where their single families are super cheap. So it's much easier for one renter to be able to cash flow the property with their rent versus going to a more expensive market, and it takes a lot more. Property taxes do play a role in that as well. We have higher property taxes in Syracuse, where in other markets it's not as high, so they can justify the price swing, but also there might be a lot of demand there popping up those home prices, and that's where it's going to make it more difficult.
What you said. Yep.
Yeah. Questions? Any other questions you guys had before we head out here?
Is there a certain class that you like to invest in, A, B, C, or D? And if so, why?
personally, we kind of played in the tertiary markets, meaning we didn't invest in downtown Chicago. We didn't invest in Naperville, the suburbs. We looked at the markets that were a little bit, they're held down by solid infrastructure. So industrial, great schools. We targeted those areas that are probably a low B, high C class, because that clientele, that tenant base, I don't know how else to put it other than this way. Like, if they were to lose their job today,
there it is.
It might hurt them that month, but next month they could find a job pretty quick paying that rent again. Where if I'm in a class A market paying $2,500, $3,000 for a, box in the sky, I think we just saw, right, with the pandemic, that a lot of these millennials and my age group, Dante's age group, and some of you guys out there are saying,
I'm not that old. No, I'm just
kidding. That you can work from home, right? And so now they have all these businesses have these offices downtown. They're like, shit, I can work from home now. And so instead of sending $3,000, I'll go to the suburbs and pay 15. The ones in the suburbs, like, I can go to get out of here and pay 8 and make the same amount of money, and I just have maybe 2 days of travel into the city or whatever it happens to be. So that's a long way of saying, C, B class, with, it's not going to be a pretty building in the sense of,
right,
aesthetically pleasing, but it's going to pay the bills. It's going to take care of everything we need to, and we're going to make it look nice, and take care of it and do the right things. But it's not, I have no interest in a class A because there's a risk reward that I don't enjoy with a class A asset. Those are the first to get hit usually in a primary market, class A market. Those are the people that their jobs, they lose $150,000 salary job. They're not finding one overnight.
Exactly. And
they might have the reserves to back them for a couple months, but eventually, those will run out if they don't find that same job, equal or greater too.
Yeah. And I wrote an article on the classes A, B, C, and D. Typically I go down to D. Some people only go to C. And, the reasons why DJ and I look for that B-, C+ class is, like you said, A class, something happens, they're going to get hit first. They're going to go to the next affordable category. They're going to drop down to B. C class, when times are really good and they're making a decent chunk of money, they're going to reward themselves a little bit and maybe jump up to a B class. So that B class is always there. With the D class, they're typically going to stay there. That's not, it's a really rough area. And the problem I have is some of these lower class C and D are older assets as well. Once you start getting to older assets, you have a lot more CapEx that's going to take place as well, and that's going to hurt you. So that's kind of look at the class aspects.
Right.
Another,
nobody moves down into an A class from a whatever's above A.
Right, AAA or something. Would you say that Syracuse is a hot market right now for multifamily 2 to 4 units? What areas would the agents in Syracuse or Syracuse investors suggest from where who are not a resident? So, I think Syracuse is a very hot market because I have clients in other countries that invest in Syracuse because it's very cash flow heavy, meaning the sales prices are low, but the rent prices are not high, but they're pretty strong. Lolita, we can chat privately just to kind of get into location a little bit more because I just don't want to take up too much time to chat on that. So yeah, hope that answers the question. Anyone else before we log off? Any questions? All right. Well, I appreciate everyone stopping in this month. TJ, thank you so much for coming in as our last minute guest. We appreciate that. Yep.
I'll send you a bill.
All right. Very good. Send it to DJ, not me. So again, guys, link in the description or link in the chat. You can head over there and check out our new group we have. And if you guys have any suggestions for topics, let me know. Other than that, everyone have a good evening.
Thank you, everyone.
Cheers, guys. Thank you so much.
Great job, TJ. Appreciate it.
Cheers, man. Thanks. No problem.